and welcome back to this day number 20 of the 50-day property challenge. Again, we'd like to thank our guests, Jared and Matt L. Welcome, guys.
Hi.
Thank you so much. Hey.
Hi, guys, and thank you again for joining us. Thank you to you out there, the public, who faithfully are watching this 50-day journey. And we hope by now you also have been able to find your first property opportunity. You may not have settled on it yet, you may not have signed the offer to purchase, but at least hopefully you are almost there and getting ready to make that first signature happen. For today, we are going to talk about the two reasons why people invest. Not only in property, but for any investment. There are two reasons generally that people invest. So let me just quickly share my presentation there. As you all know by now, the EDPF is here to change the landscape of property ownership patterns in South Africa. So we're talking mostly about property, but today we just want to quickly touch on why people invest. So let us quickly go there. There are two reasons. Number one, income, and number two, equity. Or in other words, capital or capital growth or equity growth. So when people invest for income, basically what they're doing is they're putting money into an investment, whether that be property, on the stock exchange, in a business, or any other investment for that matter. If you want to invest in Bitcoin, whatever the case may be. The first reason why people invest is income. Now, for those people who want to generate a consistent income from their investments, they will look at what the return on the investment is and what the best investment will bring them from a return perspective. And we'll talk a little bit about those metrics in the next segment. But to just be sure that when you invest, these are the two reasons why people generally invest, for income and for equity. What do we mean by equity? Equity is the difference between the value of your investment and the debt that you have on that investment. So let us, because we talk about property at the EDPF Academy, let's talk about property. On the one hand, you've got your property, let's say it's R1 million property. Then you've got your bond, which is your liability or your debt. And let's say your bond is 800,000 Rand. The difference then between your asset, which is the value of your property, R1 million, and the other side, which is your liability, your debt, your bond, which is 800,000 Rand, the difference is 200,000. That is your equity. And basically why people invest in property is that the equity over a period of time, as you repay your bond, that equity grows. So you would have paid maybe 200,000 Rand deposit on the property, thus creating the equity upfront. And then over time, as you pay down your bond starts to reduce. In a couple of years, it's maybe 600,000, and the difference then is 400,000. But you must also remember that with property, you also have generic increase in value of the property itself. Not just the difference between your bond and what you bought the property for, but also the difference between the bond and the value of your property as it increases over time. So let's say, for example, after 5 years, you've paid 100,000 Rand into your bond from a capital perspective, over and above your interest that you paid, just the capital that you repaid. Let's say you've paid 100,000 back, but your property has increased in value by 100,000 Rand. So now your property is worth 1.1 million, your bond is 700,000. So your capital growth or your equity has grown from 200,000, sorry, originally, to 400,000. So you'll see that not only is your equity growing by you paying down your bond, and therefore the difference in the capital that you owe to the bank, that creates an increase in your equity, but it also increases by the value accretion of your property itself. As the market value of your property in that area increases, your equity also increases. So property, in my perspective anyway, being the ultimate investment, is the one that is best suited not just for income, but also for equity growth. On the one hand, you're getting income on a monthly basis from your rental and other income, minus your expenses. On the other hand, you're also getting equity growth because the value that you held through your equity in that property is growing. Number one, by the paying down of your bond, and number two, by the natural accretion or increase in value of your property. So that's why for me, property is always one of the best, if not the best way to invest your money, because you get not only the income, but the value accretion and the paying down of your bond, and therefore your equity growth as well. But those are the two main reasons why people invest. It doesn't matter where you invest. Even if you're investing on the JSE, you're investing because you know, or you think you know, that that particular company is going to pay you a dividend every year. And sometimes they don't, sometimes they do. Sometimes they pay a low dividend, sometimes they pay a high dividend. But that's partly why you invest into the stock exchange, because you believe that that company is going to give you a regular dividend income. Then on the other hand, as the shares are traded, your value of your shares could increase in value, but it could also decrease depending on the sentiment of investors out there for that particular stock. So if you've invested in a property company over the last, say, 5 years, you would be very, very sad today, because what would have happened on the stock exchange is that dividends have not been paid out by most property investment companies or real estate investment trusts. So you would not have had that regular income. And on top of that, you would not have had the growth in your equity, because actually the share prices have been decreasing because there's been no dividends. On the other hand, if you've owned property in your own right, you would have had that consistent income because of your rentals, and you would have continued to have the equity growth, because your equity growth is not it's not dependent on what other people think of the value of your shares. It is more the value of your property and the difference between what you owe to the bank and what the value of the property is. So therefore, in my opinion, again, I'm not a financial advisor, so you can't take financial advice from me. But in my opinion, property investment, direct property investment, is the best way to invest your money to get both income as well as equity growth. All right, so from an income perspective, what are the things you need to look at when you make an investment? So we do what they call a back of the cigarette box calculation. All right, a lot of people in the industry will tell you about the back of the cigarette box calculation. Whether you use a piece of paper or a napkin or a actual cigarette box like my one previous boss used to do. If you're in the incubator with the EDPF Academy, your tablet actually has 15 different calculators you can use on site when you are standing on the physical property. You don't need to have a cigarette box calculation, but let's talk about these different calculations. The first one is net operating income. What is net operating income? It is your total income, that's your rental income, your recoveries that you had in electricity and water and rates and whatever other recoveries you had, your total income, less all your expenses. Now be careful here, because a lot of people will tell you that your bond repayment is an expense. It is not. Let me repeat that. Your bond repayment is not an expense. The interest that you pay to the bank within that bond repayment, that is an expense, but not the total bond repayment. What you need to understand is that your bond repayment is made up of two parts. It's partly your capital repayment of the money you actually owe, and your interest, which is the interest that they calculate on the money that you owe. So on the one side, if you're paying a bond of R1 million and your bond is, say, 10,000 Rand a month, in the first couple of years, the bulk of the money is going towards interest because your capital is so high. So let's say you're paying 9,500 Rand towards interest and 500 Rand going towards the actual capital. Therefore, after month one, even though you pay 10,000 Rand, only 500 Rand would have been deducted from the million Rand that you owe the bank. So therefore, you owe the bank 999,500 Rand. That's what you owe the bank after month one, even though you pay 10,000 Rand, because only 500 Rand of that money went against the capital. The rest was interest. Now, From an expense perspective, that 9,500 you can take off because interest is an expense. The capital of 500 Rand is not an expense. That you need to put aside for your cash flow calculation. Okay, so there's a difference between your net operating income and your net cash flow. Your net operating income is only your income minus your expenses, gives you a net operating income. All right. Now, why is that important? That's important for many reasons. Number one, in terms of being able to calculate your return on investment, your internal rate of returns, your yields, and a whole range of other calculations. But it does not allow you to calculate your cash flow because you haven't brought into consideration your capital payment. The other thing, the reason why it's important is because it is that number, the net operating income, on which you will pay tax. The capital repayment is not a deduction when you pay your tax. You must remember that it is very important, because if you make that mistake and your capital repayment is high and you use that as a deduction, the receiver is going to come after you for that difference that you owe them. And they're going to think that you're lying to them because you've submitted a false claim. So you need to be sure that you do not use the capital portion of your bond as an expense when you do your tax calculation or when you do your return on investment calculation and so on. So that's the first calculation that is very important. The next one is your yield or your cap rate. Some people call it the yield, some people call it the cap rate. Basically what that is, it determines the percentage of profits that you're going to make from your first year. Your yield is determined by your net operating income, with the calculation we just did. So let's say your income is 10,000 a month, and your total, so therefore your annual income is 120,000, and your expenses is 100,000 for the year. So now you've made 20,000 Rand net operating income. That's now excluding your capital on your bond. If you divide that by your total investment cost, now here you again need to be very careful. Your total investment cost isn't just the purchase price. It is the purchase price plus all other expenses at the beginning of the purchase. Now that could include repairs and maintenance that you've done, or at least fixing up, not repairs and maintenance, sorry, fixing up of the property at the beginning. And it could include your bond costs, your legal costs, and some other costs that you may have incurred right at the start of this investment. So you need to add up all of those calculations and things that you've spent right at the beginning as part of your total investment cost. Now, this is important for many reasons. Once again, on the one hand, it will allow you to calculate what percentage return or yield or cap rate you have on your investment as a whole. But it can also help you in terms of when you eventually sell the property and you then calculate the difference, the profit that you've made between the selling price and the purchase price. And if you are in that bracket to pay capital gains tax as opposed to normal income tax, then your capital gains tax is calculated on the selling price minus your total investment cost, plus all repairs and maintenance and other costs in order to make that property lettable. So all those costs that you've added in even while you own the property, that cost gets calculated as part of your capital input. And then when you sell your property, that is the capital output, in the beginning. The capital input is when you're getting the money back. So you subtract your selling price from all of your inputs here in terms of your capital, and then you calculate your capital gains tax on the difference. So let's say, as an example, you bought the property for 1 million, you sold it for 1.2, but you had all these other costs, and those costs are 100,000. Now, instead of paying 28% tax, if you're a company, on 200,000 because you bought for 1 million and you sold for 1.2, so the difference in profit there is 200,000. Instead of paying 28% profit on that, tax on that 200,000, what then happens is you take that extra 100,000 that you spent, you add it to your total investment cost. So therefore, your net profit then on the sale of the property is only 100,000, not 200,000. So your tax is then calculated on 100,000. But even better, you don't pay 28%. because you're paying capital gains tax, it's 14% as an example. So therefore, you're going to pay 14,000 Rand after selling your property for 1.2 million Rand, because your net gain between your input costs and your selling price is only 100,000, and your capital gains tax is only 14%. So that's why it's important to know your total investment cost. But also in order to calculate your yield or your cap rate. So you want to know what kind of profit you're making, what the percentage profit is upfront from year one in terms of the initial investment cost. So let's take that same example, and you've now spent 1.1 million Rand in purchasing this property. And your net operating capital, your net operating income, as calculated before, is say 110,000 for ease of calculation. You now have 110,000 net operating income. Your investment cost is 1.1 million. Sorry for that. If you take your 110,000 divided by your 1.1 million, you then get a calculation, a percentage of 10%. And that then is your first year's profits divided by your total investment cost, which gives you a 10% cap rate or yield. Now, this is important because you need to understand and compare your investments. So if you're looking at 7 different properties at the same time, and you do this calculation, property number 1, you are making 110,000 on 1.1 million. That is a 10% yield or cap rate. Property number 2, you've spent 2 million Rand in total, but your profit is 240,000, and you divide 240,000 by 2 million, your percentage is a bit higher. I think that's something like 12% if my numbers are correct in my head, which then tells me that property number 2, even though it's more expensive, has a better yield or cap rate or return than my first property of 1.1 million. So it will allow you to then look at properties critically and say, what is my yield or cap rate on this property? What is my yield or cap rate on that property and that property and that property? Or if you then have a choice with other investments, like investments on the stock exchange or companies that you want to invest in, you can then compare yields and cap rates to see whether you're getting a better yield from one investment to the other. So that's why your yield or cap rate is so important. The next one is your net income after cost of capital. Okay. Now, this can also be looked at as your net cash flow. All right. So depending on how you do the calculation, if you only bring into calculation your interest only, or if you bring into calculation your capital cost, then you're looking at your net cash flow. Okay. But let's look at this and say, okay, so your net income, net operating income, which excludes your capital, divided, minus your bond repayment now, which gives you your net cash flow, and then divide that by your cost of capital. All right. So now you then get your cost of capital. All right. Your net income after cost of capital. So your cost of capital is your bond and your interest. All right. So you got your net income minus your bond repayment, gives you your net income after cost of capital. Now that effectively works out and it tells you what your cash flow is. And that is important because you don't want to be in an investment where you are cash flow negative. Because what's happening there? If you're cash flow negative, you need to take money out of your pocket to pay the bond. All right. So when you compare the net income after cost of capital of all your investments, whatever that return is from a net income after cost of capital perspective, you can then say this is the better investment than that one. Okay. Then there's a thing called cash on cash return. Now, here again, it relates to your cash input and the cash that you're getting on a monthly basis or annual basis. So basically what this does is it takes your net cash flow, the calculation we just did, after your bond is paid and after your capital on your bond and your interest is paid. So you get your income and all other capital inflows, etc., minus all your expenses and your bond, then you get your net cash flow. Then you divide that by the cash that you invested, not the total investment. So let's say your investment was again 1 million 100,000. Okay. Your cash that you invested was say 100,000 because you needed to pay the bond costs and the deposit and so on and so forth. But let's say then your total cash that you invested at the start was 100,000 and not 1.1 million as per the total cost of investment. This is just the cash you put in. So now if your net cash flow is still 110,000 per annum and your net cash invested was 100,000, your return then on your cash on cash return is a lot higher than your yield or your net operating income. Why? Because you've only put in 100,000. So the calculation will give you a much higher percentage. And in this case, if you have 110,000 and net income after cost of capital, and you then have 100,000 that you've invested, your return is 110% in your first year. If you can get an investment like that, please call me because I'd like to put money into that as well, because that kind of investment is phenomenal. In most cases, your cash flow is much lower than your net income. So in most cases, you'll probably find that your net cash on cash return is closer to like a 10 or 20% mark rather than 100 or 110% mark. But it's important again to look at one investment against the other. What is, if after you've done this calculation, what is your net cash on cash return in a percentage on one investment versus another investment to then see which investment is the best one to do. Then the final one I want to talk about is return on investment. Now here it's a very simple calculation. It says how much money am I going to make at the end, or have I made, not only in the sale of the property, but also the rental incomes that I've had over the period, minus all the inputs that I put in, the purchase price, my expenses and everything. The difference between those two is then your total return on investment. Then if you take that figure, your total funds return divided by the total funds invested, you'll get your return on investment over that period of time. And then you can do all sorts of complicated calculations to see what is my annual year-on-year return on investment, what is my net cash flow for that period, what is my net present value for that period, and a whole host of other calculations you can do. But if you look at these 5 calculations that I've just shown you now, and you then compare one investment to another using all of these calculations, you can then determine which is the best investment for you. That is the reason why you do these calculations. It is quite simple. I was watching a video the other day, and in the video, this guy said, if you can't calculate the value of a property to you from these different calculations, return on investment, IRR, all of that, if you cannot do it on the back of a cigarette box, it was, in fact, he quoted Warren Buffett. If you cannot do this calculation on whether this investment is good for you on the back of a cigarette box or a piece of paper or a napkin, then that investment isn't for you. Because these calculations are quite simple. Do those calculations, compare one investment to the other, and then it will tell you which investment is the best. Okay, then let's talk about equity and equity growth and why people invest in equity growth and how you can get equity growth. There are 4 general ways that you can get good equity growth in your property portfolio. Now, as I said earlier, equity is the value of your property minus the debt, the asset value minus the debt, which will then give you that little bit, which is your equity. Okay, what either you've put in or what you've been able to negotiate. So there are 4 ways that you can receive equity and grow equity. First of all, buying at a discount or under market value. All right. So let's say the property is worth 1.5. You've managed to get the property at $1 million, and your bond is only 800,000. So therefore, because the property is 1.5, your bond is 800,000, your equity is 700,000. It's the 1.5 minus the 800,000. Okay. If, however, you bought at market value, your property is $1 million, your bond is 800,000, your equity is only 200,000. So the first way to grow equity or to build equity is to negotiate better deals. Get your property at a discount and definitely under market value. so that you can grow your equity much higher than just the difference between the value or the purchase price and the bond. The second way is to add value, what they call forced appreciation. How you add value to a property? We spoke earlier, or yesterday in fact, I think it was, where we spoke about buying the worst property on the best street. If you buy the worst property, you can then do a spit and a polish, you can do some painting, you can do some tiling, you can put in some cupboards, fix the kitchen, fix the bathroom, and through that, increase the value of the property by doing renovations to the property, what they call forced appreciation. So you can take a property of $1 million, spend 100 or 200,000 on it, but then increase its value to 1.5 million or even higher. And therefore, let's say you spent 1.2 million to buy it, 200,000 on the renovations, but you increase the value to 1.5. Instead of having zero equity, you now have 300,000 rands worth of equity because the value is 1.5, but you only spent 1.2. So that's forced appreciation and adding value to your equity. The next one is to pay down your bond quicker than expected. Now, there are lots of calculations you can use, and one of the calculators that we have on our tablet is a bond reduction calculation. And basically what that calculator does, it says to you, if you pay X amount onto your bond extra, you can increase the equity portion of your property value much quicker because you've now reduced your bond in a quicker way. All right, so normally your bond will be 20 years. And let's say you've got a property of R1 million and you pay 10,000 Rand a month. If you pay 1,000 Rand a month extra, you can reduce your bond easily, I think, to about from 20 years down to about 16 years or 15.33 years was the calculation I did the other day. So therefore, you can now reduce your equity or increase your equity by reducing your bond quicker. And then in 15 years, as opposed to 20 years, have the full value of the property be your equity because there's no more bond. So the value of the property then is increased from 1 million to say 1.8 million, but your bond is reduced from 800,000 down to zero in 15 years and not 20 years. So now in year 15, you've got equity of 1.8 million because your bond is zero, as opposed to having still a bond left at that time if you haven't reduced your bond by more payments. So that's the third way of increasing your equity by paying off your bond quicker. Then there's passive price appreciation. That's the last way. Basically, what you can do is do nothing. Do nothing. Pay off your bond in the 20 years. And basically what will then happen, as you pay your bond, the capital will decrease in what you owe the bank. Your bond will decrease, but your asset will increase. And therefore, the equity naturally increases because your property is increasing in value, your bond is reducing. So that variance, that difference is increasing your equity in a passive way, where you've actually done nothing but pay your bond. And therefore, your equity is increasing. So that's it, guys. We talk about 2 reasons why you want to invest: income, equity, and those are the ways that you can utilize in order to calculate whether you should, number 1, invest in a property, and number 2, increase the value of your equity. Okay, guys, that's it. Jared and Matt, any questions from your side? I think that's it from my presentation. Yes, it's short.
I don't have any questions. Thank you so much. It was just a lot to absorb, but thank you for sharing that.
Matt, nothing from you?
No, I'm also just soaking in. It's been, a long 20 days of information. So again, just taking a lot of notes.
I think that's the thing about this 50-day challenge, because we are trying to teach you so much in such a short space of time. It's going to take a while to absorb. Fortunately for everybody that's watching, we record everything and we put it on our website and on our YouTube channel. So if you missed something, you can easily just go back and watch it again and get yourself a refresher. But yes, you're right, guys. There is a lot of information to absorb, but hopefully, as we've gone through this process, I know the 2 of you have already got some exciting news for us tonight. But hopefully, the rest of the public that are watching us have also started this journey, and now after 20 days have started to look at property investment opportunities. So thank you guys once again for joining us, both Matt, Al, Jared, as well as you guys out there, the public at large. Thank you, Private Property, once again for being part of this journey, and thank you for allowing us your platform to teach the public about how to invest in property in 50 days. This is Nigel from the EDPF Property Academy, Jared Ricketts and Matt Al signing off for day 20, and we'll see you tonight at 8:30 on Facebook as we wrap up week number 4. Thank you, everybody, and goodbye.